Hello all. Welcome to this new quarterly webinar session. I'm Julien Waro. I'm in charge of the EnergyScan platform here at NG Global Energy Management. So sorry for this technical issue. We had to switch the last minute to this Teams live event due to technical problem with our webinar service provider. So we are living an unprecedented period on energy markets with an historical gas supply shortage in Europe, triggering extreme gas and power price variations. So uncertainty about the global gas balance and even security of supply have never been so high at the beginning of the winter season. So today in this 1 hour webinar session, we'll try to give you more clarity on the potential scenarios for the coming months with a specific focus on natural gas, of course. So I have the pleasure to introduce two new speakers for this session. First, Adrien Meo, who is a natural gas and LNG analyst for trading and portfolio activities. He will open the session with a focus on key natural gas fundamentals. He will be followed by Fabien Lefebvre, who is a natural gas trader dedicated to market making activities. He will share his view on the current gas market conditions and in an exclusive live conversation. And then Évariste will end the session with a focus on coal and power markets, which we can consider as collateral victims of this global natural gas shortage to some extent. So let me remind you that this is an interactive session, so don't hesitate to use the chat module to ask questions to our speakers. We'll do a Q&A session after each presentation. So the slides and a replay of the session will be available by tomorrow at the latest on the EnergyScan platform. So I think it's time to start with Adrien. So Adrien, the floor is yours now.
Thanks, Julien. Is the sound okay?
Yeah, okay.
All right, perfect. So first and foremost, I would like to take a bit of time to see how we got there in that extremely challenging situation. The European and LNG markets have seen a dramatic shift in gas fundamentals, moving from post-COVID oversupply to extreme undersupply in just a few months. So really, let's keep in mind that the European markets, liquid hubs and ample storage capacity enable it to absorb global supply and demand shocks. This is where the global gas market usually balances, but this time we are perhaps nearing its limits. So the chart on the right breaks down the drivers of the sharp drop in European stock levels between the 1st of October 2020 and the 1st of October 2021. So we are down 18 BCM on year for a capacity of 90 BCM. It's a massive drop year on year. To give you an idea of the deficit, this is the size of the residential, commercial, and small industrial demand in Belgium and the Netherlands combined. So it's huge. We are also, as you can see on the left, 12 BCM below historical average and far below the previous record low. So over the period from October 2020 to September 21, Europe lost 24 BCM of LNG imports. That's a 25% drop. It's massive. Domestic production also collapsed by 9 BCM, especially in the UK, because summer maintenances in 2020 were postponed because of COVID restrictions to this summer. And as well, heating demand surged by 19 BCM due to a colder winter year on year, and as well, perhaps most importantly, a very cold spring, which delayed injections by weeks. So these are the tightening factors that you can see on the right-hand chart, the red bars. Among the loosening factors in green on the chart, we see that Algerian flows ramped up massively. This is because they are oil indexed and therefore deep in the money. They are up 15 BCM year on year, while Azerbaijani flows have started in January, have started this year, and are up 5 BCM. A loosening factor, an important one as well, was the reduction of exports to Ukraine and Hungary. Last year, Ukraine was extremely important for the European market to balance. This is where Europe evacuated a lot of its surplus. Of course, this year, this was no longer needed, so Europe reduced drastically its exports to Ukraine. As well, CCGTs were pushed well behind coal in the power merit order, as gas prices went up much more than EUAs and coal prices. And finally, Norwegian production was also maxed out. So you may have noticed that I carefully avoided to mention Russia until now, and this is because it deserves a bit of time to really understand what's going on. It's more complex than it looks, and certainly a bit more complex than what we can sometimes read in some mass media. So let's dive into it in the next slide, please. So a zoom on Russia and LNG. On the chart on the left, I am breaking down the Russian gas balance between gas year 19, so which runs between October 2019 and September 20, and gas year 20, which ran from October 2020 to the end of last month. The blue bars on the left and right are Russian exports to Western Europe. You can see that they dropped by 5 BCM from 118 to 113 BCM. There is a small problem on the numbers. Here, just it's not 11.8, it's 118 BCM times 10. You can see that exports to Western Europe dropped by 5 BCM. How is that? Is it that Russian production decreased? Well, not at all. Quite the contrary. In fact, you can see the big green bar. This is the increase in Russian domestic production over the past gas year. Russian domestic production rose by 61 BCM to a record high. So that's a massive increase. And actually, this increase in supply was fully offset by a surge in Russian domestic consumption. They had a very cold winter, and they also further expanded the gasification of the country. So Russian domestic production is massively up year on year as well. On top of that, we had a very strong rise in contractual flows to Turkey. This is extremely important. Contractual flows to Turkey were up 18 BCM year on year. And to understand that, you need to realize that those flows are oil indexed as well. So they are deep in the money. And BOTAŞ, the Turkish incumbent, obviously chooses to max out Russian supplies instead of going on the spot market, on the spot LNG market in particular. And then the other element was a rise in flows to China by 6 BCM. But this is a separate resource base and not really competing with exports to Europe. So on top of that, the launch of Turk Stream 2 reshuffled a bit the flows in Eastern Europe, with Ukraine transit being less needed for Gazprom to supply Southeastern countries. So we had massive domestic demand, massive exports to Turkey, and a huge need for reinjections into Russian storages over this summer, after the cold winter that they had. And that left Gazprom in actually a tight position. I'm not even mentioning an incident on a key infrastructure asset in Urengoy in August, which added some pressure. Therefore, since August, Gazprom has reduced exports to Western Europe to broadly the level of long-term contracts of Western European buyers. And I really want to stress that it's a key change for the European market, which had become inadvertently addicted to Gazprom spot sales above long-term contracts in the past 4 to 5 years. So this is a complete shift in the European picture. Now, if we turn to the chart on the right, we will see that unfortunately, and I touched upon that on the previous slide, LNG provided all but relief. On the supply side, so the left part of the chart, you see that liquefaction utilization plunged in many major exporting countries, either because of severe outages, like in Norway, for instance, the plant caught fire. It will not come back until at least April 2022, or Nigeria, Malaysia, but as well accelerating upstream declines, as in Trinidad, which lost 7 BCM of LNG production this year, or Indonesia. So actually, even the US, which posted a massive 31 BCM gain after the commercial shut-ins of summer 2020, they actually underperformed. They were hit by hurricanes in Q4 2020, and they had a big freeze in Texas in February 21, which hampered operations at several plants, in particular Freeport and Cameron. So the US posted a gain, but they could have done better actually. And on the demand side, the right-hand side of the chart, you see that the economic rebound in Asia and China in particular has been massive. And LNG demand in the Far East, so China, Taiwan, Korea, and Japan, surged by 32 BCM year on year. On top of that, Brazil experienced the most severe drought in decades, and they had to turn to CCGTs to balance their power system, because hydro generation plunged. And so we saw Brazil basically going in the spot market and taking massive amount of LNG. They are up 8 BCM year on year. So all that contributed to a massive tightening of the LNG market. We expect some normalization this winter if the upstream issues are resolved, but we don't expect a massive improvement either. So LNG really added to the tightness in the European market, unfortunately. So if you go to the next slide, to summarize, we are maxed out on all supplies. All price responsive supplies have long been in the money. Algeria, for instance, I've discussed that. Norway as well, they have produced everything that they could. And the switch from gas to coal in the European power sector is complete. You can see on the chart that the TTF in orange rose well above the coal to gas switching channel in gray on the chart, which means that CCGTs are less profitable than coal plants. As well, if you look at the JKM in blue, you see that it's way above the Asian oil switching price. So it's a proxy, but you can see that we are way beyond it, which means that some Asian countries are switching to oil-fired generation, unfortunately, we understand that the potential in terms of demand destruction might be a bit limited. Certainly in Europe, it is actually. So to do more, we need to destroy some demand, and in particular, industrial demand. But it's very important to understand it. The diffuse and asynchronous nature of industrial demand destruction makes the price discovery process much more opaque and therefore contributes to the exceptional volatility that we are currently seeing. For instance, we can see some fertilizers curbing output, but it's not really clear what is the overall quantity that is gone and at what price. It's not a process that is well understood, as is, for instance, the gas to coal switch in Europe. Hence, the volatility and the fact that the market is somewhat lost. That brings us back to Russia. And for this winter, we believe that if Russia does not ramp up exports using basically all existing routes and some of the Nord Stream 2 capacity, then Europe is likely to rely on mild weather and or unforeseen loosening of the global energy market on top of industrial demand destruction. The risk really is that storage levels would be too low to offer enough flexibility to the system to cope with cold snaps towards the end of the winter, leading to unserved demand. And in terms of prices, well, that would be, of course, catastrophic. But for Russia to ramp up supplies, exports, there are big hurdles. First and foremost, it's not clear whether Gazprom has enough gas to massively increase exports to Western Europe. We understand, however, that Gazprom is close to finishing its injection campaign into Russian storages. And therefore, we might see possibly some volumes coming back to Europe, but that's not a given. And even if Gazprom has the gas, it may not be able to use Nord Stream 2 before months, because it first needs to get regulatory approval, regulatory certification from the German regulator BNetzA. A recent press release from this German regulator mentioned that a startup of Nord Stream 2 without full regulatory clearance would be in breach of regulation, and Nord Stream 2 AG would therefore be exposed to fines. Perhaps this is an acknowledgement of the fact that Gazprom could be tempted to start up Nord Stream 2 flows without full regulatory clearance, but this is pure speculation, and we lack actually material facts to believe this could happen. So we are in this extremely uncertain context. The price has not much to do, and therefore we are left with exceptional volatility for the remainder of the winter, with a huge weather risk, and I guess the markets will be extremely dependent on weather this winter, much more than in any other winters. So with that, Julien, I leave it to you if there are any questions.
Thanks a lot, Adrien, for this presentation. So we are accumulating technical issues this morning, as I was informed that the chat module is not active for this session. So if you have any question, please respond to the email we sent just before the meeting with the new link for the Teams live event. So Adrien, we'll start with a few questions. Of course, what are the next key events for the coming weeks to watch out for natural gas markets?
So the next key event clearly is the monthly auction next Monday for capacity. So we will see whether Gazprom books more capacity through Poland than it did for October 21. So last September, that was quite a shock for a number of market participants. Gazprom only booked, I think it's less than 40% of the capacity that was offered for transit through Poland. So that basically showcased the fact that Gazprom was tight in its domestic market and was not really able to ramp up flows to Western Europe. So we will see what Gazprom books next Monday. I expect massive volatility so next Monday. We have seen such patterns for all summer when during days where there is a monthly capacity auction, third Monday of each month, there is an extremely strong volatility because the market basically tries to anticipate what Gazprom would book. So we will need to watch that. And of course, if they were to book the same level of capacity through Poland, that would be a bad news for the market and for the winter to come.
Okay, thank you, Adrien. Are there any possibilities to increase supply elsewhere across Europe? We heard about a possible increase in Norwegian gas production, or what about Groningen as well?
So the answer is no. The production quotas for the two major flexible Norwegian fields, Troll and Osberg, were increased lately. But you need to know that over winter, their production is already maximized. So in effect, it will only basically allow Equinor to ramp up production during shoulder months. So we're looking at April, actually. So it's too late. And there's nothing to expect for this winter, really, from Norway. They're already maxed out. Then for Groningen, the Dutch government already said that they would not increase production just because of the risk of tremors. And politically, it would be, I guess, too difficult. So they already said that they wouldn't ramp up Groningen. Groningen is weather responsive, so if it's very cold, they will be able to ramp up a little bit their production, but we cannot count on that to rebalance the market. Perhaps I want also to stress the fact that Algerian flow are expected to be maxed out as well because they are deep in the money by thousands of euros per megawatt hour. But there is currently a political dispute between Spain and Morocco, and between Morocco and Algeria, which means that the GME transit pipeline might not be renewed on the 1st of November. And that could a bit cap Algerian pipe flows to Spain. It's not a good news either. Given the recent political developments between those three countries, I'm not sure we can hope for good news, but we will see.
Okay, thank you, Adrien. We receive a question regarding demand destruction in Europe. Do you have any numbers on the possible extent, especially in the industrial sector?
This is a tough one, and this is something that we are trying to monitor closely. We are starting to see some industrial destruction. First, we heard most fertilizer companies saying that they were curbing output. And to give you an idea, the fertilizer industry consumes around 15 BCM of gas on a yearly basis in Europe. So we know that they're curbing outputs, and we are starting to see some demand destruction from large industrial users in the order of 15%. So that would be around 1 BCM per month, but it's still very early. And given the very noisy nature of the data that's available to us, We cannot say for sure how much demand destruction we are looking at, but early estimates are in the order of 1 BCM per month. This is not enough to rebalance Europe in the event that Russian flows would stay where they are throughout the whole winter.
Okay, and one last question regarding the years 22 and 2023. Is there any fundamentals that can justify the fact that the summer price is above the winter contract?
Well, we are most likely going to end winter with extremely low levels of gas in store, which means that we will have a massive need for reinjection next summer. And to do that, we will need basically to destroy gas to power demand in particular. So the TTF in summer 22, we need to rise with regards to EUA and coal prices. That's pushing up let's say the front of the curve, and this is a typical pattern that we see when the market is tight. The front contracts are lifted more than the rest of the curve. It's quite can appear paradoxical, but this is what we usually see. You can also see, for instance, on the chart that the coal to gas switching channel is heavily backwardated. This is because of the backwardation of coal, and this also contributes to pushing up the front contract for the TTF. So and we can see on that chart that for summer 22, basically there is still a lot of upside for the TTF to move out of the coal to gas switching channel and to let's say fully exhaust the gas to coal switching process. Also, one thing to bear in mind, there is a lot of premium on the April 22 contract because there is still some weather risk on the April contract. If you look at the balance of summer, it's actually not that high with regards to winter. So it's really a lot of premium on the April contract, and I guess a lot of volatility on that specific contract as well.
All right. Thanks a lot, Adrien, for this presentation and your answers. So it's time to move on to the second part of this webinar session. So we can welcome Fabien Lefebvre. It's a great pleasure to have you on board, Fabien.
Pleasure is all mine.
I think it's the first time that one of our traders is sharing his view in a webinar session open to our clients. So Fabien, can you just explain in a few sentences what is your role and objective as a natural gas trader here at ENGIE Global Energy Management?
Sure, of course. Can you hear me properly?
Yes.
Okay. So thanks for having me, Julien. That was way too much of an introduction, and thank you, Adrien, for this very nice macroeconomic insights. So just before I start on what the market making role actually is, it's true that we are facing on the forward markets a very, very special situation because we have been seeing throughout the past years price hikes. That's not something very new. They have been occurring before, but it was on a very short-term basis typically during end of winter cold snaps when we have empty storages and there's a tension on say on 1 day or two, and we could see the spot contracts going to the roof, but it was maybe day ahead or eventually end of month quotation. And here, for the first time, well, at least the first time in my career, we see a structural shortage, which is really new in the abundance culture we used to have, and there's therefore the consequences. There's a run for molecule, no more, no less, and even before the actual beginning of winter, because we can anticipate there's going to be an issue. It's not something we discover in March or in February. And there's always, in that case, when you have a run on the markets, it can be stock market, it can be power market, it can be any market. There's always a snowball effect because whenever you hit a threshold, a psychological level of make it 50, 60, 70, even 100 euros. We've been seeing recently. Well, it's going to trigger stop loss levels, and it puts even more demand in the market. And since, as Adrien very efficiently explained it, there's no marginal production we can put in front of that. So then the key to the adjustment of the market is left to demand destruction. So there's a huge uncertainty on that in terms of scale and levels. And of course, the weather. So it leaves us with massive price movements, which we have never seen, and of course, a volatility which is hard to manage. So back to my trading rules now, if I may. When you act on a forward market, so I think you're all familiar with what a forward market is. You have people who want to hedge a production, some people who want to hedge a consumption, more speculative operators in the middle, and you can trade live prices throughout the whole time frame, spanning on more or less 10 years. But you have different subtypes of financial operators, and I'll divide them into 3 categories and try to be as quick as I can. First of all, you have the asset-backed trading. So it's typically linked with the utilities. Whenever you need to supply physical, tangible customers with gas, well, then you need to have storages, you need to have pipelines, you need to have long-term contracts with flexibility, and all this needs to be optimized. If you have a pipeline between France and Germany, then you have more or less of an option on the geographic spread between the 2 markets. So are you gonna monetize the spread in the winter in delivery or 3 years in advance? Well, you need to have a whole analysis behind to try to extract the best time value of your physical portfolio. Then a second category would be the notorious PT traders, which you often hear of in the politic speeches as being more or less the Antichrist. Well, then they aim, as George Soros would do quite notoriously on the currencies, they aim at drawing P&L, so more profits from pure market fluctuations. They have no customer, they have no assets, they enter an exit position before they settle, and try to, if you start by buying, well, then you have to sell higher, and if you start by selling, you have to buy cheaper. And finally, we have the last category, which is my sector, which is market making. Our activity is to provide customers with an access to those futures markets, and we are called market maker because we provide constant prices for any requests on the buy or the sell side, because a customer portfolio can involve producers and any kind of industrial asset or company. So typically what we'll do is we're going to transfer a volatile and risky position from a customer's book to ours. And knowing that we're not a physical operator, we don't have clients and we don't have assets, we provide a financial service based on a physical quotation. We will need at some point to offset that position ourselves on the global market later on. So we endorse risk, and then we have to unwind it on the very same market we give access to. And those offset possibilities will depend on the complexity of the product and, of course, market's liquidity. And that's why there's a very variable risk premium, which we can propose for each request. And in knowing that, a legitimate question would be, why don't companies access themselves on the global markets? Well, the reason is quite simple. It's because accessing those markets comes with various and important costs. Some of them very structural, such as hardware, software, licenses. You need to access routers. You need to access exchanges. You need to set up IT teams. All this is very costly, and you cannot quite get on without it. And you also have more subtle costs, which you cannot see in the first place. But if ever you trade on an exchange with a compensation chamber, well, then you're going to have to provide margin calls, which have been more or less democratized in public opinion by a famous movie which you may have seen. And this has a huge cost in terms of treasury, and the bigger the interest rates, the bigger the cost. And that can be a burden, especially for small companies. And if you don't have margin calls, well, then you trade bilaterally, which means you have a credit risk. And that's also a problem, because whoever owes you money and goes into bankruptcy can trigger a chain reaction and put yourself at bankruptcy risk as well. A final risk, and I'm not gonna burden you with all the risk categories today, but another risk which is not always self-evident is the regulation risk. Whenever you trade on the futures markets, you can bias and therefore manipulate indexations. Indexes such as Heron, such as ICE, which are going to be the typical index used in long-term gas contracts, with billions of euro being pegged to it. So they're very, very watched by the regulator, and if ever they believe that you have some sort of a pattern trying to influence them on the downwards or upwards, even if it's something you didn't do on purpose, you forgot an order, or you did what we call a fat finger, you mistaken a figure for the other, you can be very personally liable and eventually go to prison. So that's the kind of risk that companies tend to avoid, and that's why they transfer the market access to us. And since we have the expertise and the staff and of course a large portfolio of customer, well, we can do scale economies and show them the best prices to hedge their risk. So that's I hope put in a nutshell what we do on the market and what happens when you show a price request as customers to NG.
Okay, thanks Fabien for this introduction. So let me remind you that you can still send us questions by email. So Fabien, how can you explain this extreme volatility level observed at European gas hubs over the past few weeks? Just to illustrate that, here are two charts. The first one on the left is about the massive drop in liquidity in daily traded volumes, notably at the Dutch TTF. And the second chart on the right, it's an assessment of the bid-ask spread at the close for the TTF front months contract based on data from ICIS, and we can see a massive jump in this bid-ask spread. So how do you interpret that, Fabien? And what is your view on this?
Well, that's typically the kind of price jump we would explain by a fat finger and saying someone messed up a 10 for 100, but no, sadly it actually happened for many reasons which were explained before. The main reason being price making process is quite a simple one, actually. It's the meeting of a demand and an offer, and we're in the unseen before case where we actually have no additional offer to provide for a very structural and important demand. And mathematically, whenever you have no offer left to show to a rising demand, well, then there's no reason for which you would have a price limitation before an actual destruction of demand process. And why was it so brutal? Well, it was brutal indeed, but there were some steps before that. First alert was cold early spring in Europe, typically early April, and you're supposed to be massively injecting in your storages to start preparing your next winter, and to cope with any disruption you could have in August and September, and not being under stress early October. Except this spring was quite cold. And I remember personally having the general heating system of my flat being cut only somewhere like mid-May, which was kind of rare for the sweet Parisian weather we all enjoy. And so that was the first issue. So prices started to be quite strong and quite supported even in the summer period. And then we saw there was quite a shortage of LNG, which Adrien explained before. So that was another alert, and we saw that there wouldn't be no help on that. And then we have been experiencing it's always the geopolitics of gas, so you never know if it's quite in good faith or not. But some Russian disruptions on the historical Ukrainian routes. With a huge, very friendly pressure to validate Nord Stream 2 and the shortest delay. So since that was, it's still a very dodgy political subject, so it was not validated within weeks, and it's not expected to be. That was another alert to see that there would be no help from liquid gas, there would be no help from Russian gas, and so it was starting on there. It was a constant buildup of 2 euros per megawatt hours, 3 euros per megawatt hours rise per day, which was already a big move. To give you an example, my personal threshold for a harsh move was the invasion of eastern Ukraine, and the monthly TTF, which is kind of the TTF is the balancing hub of the entire Europe, and front months is the reference contract in terms of liquidity and trade volumes, and it bounced by somewhere like 3 euros per megawatt hours on a price which was around say 20 or 25, and it was believed to be a huge move. Usually we live with 30 to 40 cents daily exposures, so having a somewhat banalization of the 3 euro move was already a strong hike in volatility. And then we started entering the October period, and what happened was the first weather expectations, when they start to count, when they start to actually mean heating consumptions, showed that we would have no salvation from there as well, because they were actually pretty cold on the first 15 days of October, and then started what we can basically name a market panic. And many operators tried to hedge at once their winter volumes, except everybody had the same idea at the same time. So no offers to face them. Well, then the rest is a history you all know. We had a day. We had 2 or 3 insane days where we almost reached and then broke the 100. Very psychological but quite impressive 100 euro margin. And the next day, a crazy move from 110 to 160, which then crashed down during the day, because whenever you have a snowball and a panic effect, at some point people start pulling their hands off the keyboard and give themselves more time to think. And you have what we call the overshoot, where market volatility goes crazy in one way or the other. Obviously, when you're at 20 euros value, you're not going to make the market move by 10 euros without any fundamental reason. When you came from 80 to 160, well, then the meaning is it's easier to since nobody has a reference, and there's nobody who's going to put prices levels, hidden prices levels, saying that if ever the market crosses the 90, I'm going to put 1 tera. If ever the market goes above 120, I'm going to put an offer. Nobody knows where the optimal level would be, because there's no reference in any case. Well, then that's why once you broke any psychological level and you have no idea of say the real balance, a physical balance, because you need the industrial destruction demand, and nobody knows to which extent it can go. Well, in that case, the volatility becomes wild, because there's nobody to stabilize the market with bids or offers, because everybody is just more or less trying to save his life and pull back his hands from the fire.
Okay, we received a question by email. What is your view on the level of speculation and proprietary trading positions, and their contribution to the price spikes on top of the discussed fundamentals?
I wouldn't have a view on is it a high level or a low level or what level it should be. But if you look at something which is quite descriptive, you can always compare the actual physical flows running through the TTF or say the Dutch transport system operators, which is in the end the physical truth of the gas consumption, compared to the flows on the market, and obviously the multiplication factor is quite high. But it's not always. It's hard to draw a very hard line between raw PT speculation and the behavior of, say, not legitimate, but more industrial hedging attempts. Because even as if you have a financial exposition, say to Heron Day head reference, you're completely free to hedge it with a swap and then unwind it and then rehedge and then unhedge according on your hedging policy. Anyone acting on futures market, be they an investment fund with a purely PT attitude, or a physical corporation which is going to do an S-curve, which is going to do a hedging strategy with minimums and maximums, stop losses and take profits. And in that case, they become themselves somewhat of a speculator, and they can also fuel the multiplication level between TTF, between the real flows and the financial flows. So it's not exactly like say the housing market where you could see, or if, I think it was in Dubai or some wild place like that, where before it was actually inhabited by people, any flat would be sold and bought by 17 times or so. That indeed is a pure speculative ratio. But on gas, you also have the hedging strategies and unwinding and rehedging strategies of very industrial and very physical businesses. So I couldn't tell you a true figure saying, well, there's actually 60% physical business and 40% purely speculative, or the opposite. But it probably went downwards, because when you have the market going out of its range in any manner, I don't see any fund or any fundamental PT player which did not at some point either take his profit or either stopped attempting to do anything this year, because in that case you leave it to a pure hedging and physical issue. You're not going to play a downward move or upwards move when you went from 80 to 160. Whatever your rationale behind entering the market is, it makes you very modest. That's my personal opinion, at least.
Okay, thank you, Fabien, for this conversation. So we are running a bit late, so we have to move on to the last part with Évariste. So thanks again, Fabien. So just before we switch to the last part, one last graph just to illustrate the conversation with Fabien. We just computed the daily ratio of the max minus min divided by min for some energy contracts and also the Bitcoin. And you can see that last week the TTF front month contract, especially last Wednesday, a week ago, had an intraday variation of 63%. In relative terms, so this is absolutely huge, and it was above the biggest variation of Bitcoin and also the WTI first nearby contract, which traded in negative territory in April 2020. So thanks, Fabien. Évariste.
Thanks for your time.
Yeah, cheers, Fabien. Évariste, it's your turn now. We are running a bit late. Sorry for that, and the floor is yours.
Thank you, Julien. Can you hear me?
Yes.
Okay, so we can go to the first slide. So as explained by Adrien and Fabien, if the European gas market is so tight, of course, this is due to the weakness of Russian supply. But the other element is clearly the weak LNG flows we are having. Why do we have such weak LNG flows? This is just because Asia is taking a lot. On this slide, we have put some elements on the four main LNG buyers, the biggest one worldwide, China, Japan, South Korea, and India. Of course, those countries are important for the LNG market, but they are even more important for the coal market. As you can see it in their power generation mix, coal is dominant, at least in China and India. In Japan and South Korea, situation is a little bit different. Starting with Japan, when you look at carefully the graph, you see that oil-fired generation is rather important. Of course, it's not at the level of gas or coal, but there are a lot of terawatt hours that are burned for power consumption on oil. Recently, maybe you heard about a lot of talks about switching from gas and coal to oil-fired generation. Just as a reminder, I put some figures about the level of oil-fired generation years ago. It was in 2012, just after the Fukushima disaster. You see that the level jumped to more than 200. Quite a huge increase just to compensate the lots of nuclear generation. And afterwards, the years later, this level dropped. This level dropped thanks to the recovery of nuclear generation. And last year, we were at around 40 terawatt hour. Of course, this is not massive, but this can help if you believe that we can increase this volume. And actually, since the start of the year, we are seeing in Japan an increase in oil-fired generation. Unfortunately, these substitutions so far are not high enough, in fact, to really curb the uptrend in gas and coal prices. And now coming back to China, of course, gas-fired generation is still rather weak, but be careful, the share is gradually increasing. And on top of that, the share is the volumes are low in the scale of China, but when you turn to the international market, those volumes can be rather important, as you can see it on the next slide, Julien. With a special focus on China, on the table, in fact, you have the oil, gas, and coal consumption for the main sectors. Of course, we are in China with GDP, which is mainly based on industry. So you have a huge consumption both on gas, coal, and electricity for the industrial sector. These figures are for the last year. For this year, you can revert to the table, which is just the graph, which is just below. And since the start of the year, if you take from Jan to August, we have a quite strong increase in power demand. So power demand was already very strong in 2020, despite the COVID impact. But this year we are increasing at a pace on average of around 14. This is massive. Although, if you look at carefully the graph, you are seeing a slowdown, and the slowdown in particularly marked in industrial sector. I put some figure here for some energy intensive sectors, the chemical industry, the building materials. You have also some metals, ferrous and non-ferrous, and you see that on those sectors we are seeing clearly a slowdown. With almost on some sectors only 1% growth year on year compared to in August compared to the trend since the start of the year. So there is clearly a slowdown. But as I say now, we are in China, volumes are rather huge. So only 1% increase in Chinese power demand can have an impact on the LNG market. And you can revert to the table to see that one. Now we are talking about the gas consumption, which can be very weak, either in the industry, residential, but those volumes are quite significant if you compare them to what Europe is consuming, for instance. So we have to be careful about that. Julien, we can move to the next one. We have to be careful, and we have also to look at what the power market is sending in terms of signals, and also the coal market. So China is dominant on the coal market. Here you have a trend in the China coal prices. I'll just look at the graph on the left. Prices are still very strong, and this morning they continue to increase. Chinese authorities are doing all they can, in fact, to try to curb the upward pressure. And the recent measure was to ask the two top coal producing regions to boost output. But so far, they are trying to do it for weeks. And so far, the measure has not produced effects. But the last measure was also to try to allow power producers to increase their tariffs to energy consumers. As you know, in China, they don't have markets like us, at least not as developed as our markets. There are just some pilot markets in some regions, but the bulk of power is still sold via grid tariffs. And so far, grid tariffs didn't, let us say, follow the rise in coal prices. So it's only from last week that authorities decided now to allow power producers to increase their tariffs to industrial customers. What is the idea behind? Clearly, to trigger price-driven demand destruction. We talk a lot about demand destruction in Europe, but in China, they are also trying to do demand destruction. So far, what they did was rather mandatory demand destruction, forcing some industrials to cut. But now with this new measure, increasing prices, they are trying to trigger a price-driven demand destruction. It's too early to see if the measure will finally produce some effects. The other graphs are the global indices. You have the API 2, API 4 and 6 for Australia and also South Africa. And the last one on bottom left, you have the trend on the API 2 in a technical point of view. In fact, the prices collapsed last week. They collapsed last week as gas prices. When they collapsed at that time, I hope that this was the consequence of the new measure decided by Chinese authorities. But when you look at carefully the graph, prices took support from what we estimate to be their 20-day low, and then they rebounded. And as I said, they continue to rebound it to today. What does it mean? It means that so far the trend is still upward. Despite this drop, we should consider that maybe this drop is just a technical one and that the trend is still very bullish. So this is for China and for the global market. Julien, we can move to the next slide. So in China, as I say, we don't have real marketplaces, but we have them in Asia, in other countries, or we have them in Japan. We have them as well in India. So you see here let's start with the one in India, for instance, which is just below on the bottom. You see that prices are increasing, and they start to increase quite significantly since the start of October. In fact, if you compare current prices versus last year, we are multiplying prices by more than 4. So sharp increase in prices in India. It seems that there is not really a coal scarcity. There are some commercial dispute between the dominant state-owned coal supplier and the buyers. So maybe the situation is much more commercial than really physical. But what the market is sending as signal is clearly that there is a tightness as on the other markets. And we believe that Indian prices are just reacting to the increase in coal prices. The same for Japan. When you look at the graph on the right, and here you have the curve for Japan with the market of Tokyo. You see that prices since end of December are also increasing. When you compare the levels to what could be a marginal price based on GKM, of course we are lower. We are lower. Just if you remember the graph on the Japan power mix, gas is important, but coal is also important. So these levels which are below the levels we can see in Europe, you can say that they are between the coal cost and the gas cost, in fact. And on top of that, since the start of the year, we are seeing in Japan a recovery, a strong increase in nuclear generation, meaning that the coal to thermal generation, to gas and coal, is lower. The two other graphs show you the seasonality in the Asian demand. The summer peak is over, but now in Japan, in South Korea, and also in China, we are heading gradually to the winter peak. And what will happen in those countries in terms of weather as well will be important for our European market. Julien? So now let's switch to Europe just to illustrate the demand destruction that happened on the power generation sector. With here the example of Germany and Netherlands, you see clearly that coal-fired generation increase. When you take a set of the six major European markets, Germany, Netherlands, UK, Italy, France, and Spain, since the start of the year, coal-fired generation is up by 26%, and at the same time, gas-fired generation is down on average -3%. Knowing that the start of the year was rather bullish for gas-fired generation, at the time gas prices were not so high, so at that time you didn't need to destroy gas demand in power generation. But starting May, with the surge in gas prices, of course, gas became less competitive than coal, and from May we saw a strong decrease in the gas demand for power generation in those countries. So this increase in coal-fired generation has an impact in the context of global tightness in coal supply. Of course, higher demand just means that at the end of the day, you have to live with very low stock levels, as you can see it on the graph on the right with ARA stock levels. Julia? So some words about the EUA market. On the graph on the left, you see that the EUA price, in fact, it follows the gas price until, let us say, early September. Why? Because the increase in gas prices tend to increase the CO2, what we call the CO2 implied switching levels. So you gradually switch from gas-fired generation to coal-fired generation. Switching to coal-fired generation means that you need more EUA because they are emitting more. You need more EUA to buy more EUAs. And that process explains the positive correlation between the gas and EUA until early September. But from early September, you see clearly on the graph the kind of disconnection between the two, because we believe, and our estimates tend to show it, believe that we have almost exhausted the switching potential. For this winter, it is clear the switching potential is exhausted. Starting the summer, maybe there are still some remaining potential. But as soon as we exhaust the switching potential, of course, we disconnect the two markets. So this is the fundamental explanation. But I also like some technical explanation. Just look at the graph on the right. The graph is telling us that, of course, the EUA price is upward. This is the long-term trend, starting from all the changes made at the European level with the stability mechanism and so on. So this graph is upward, showing that we believe that the EUA market will be upward. But it seems that on this overall uptrend, prices are also reacting to some technical levels, trying not to be too much overbought. So clearly, what we estimate to be the one-year high is setting a kind of resistance to EUA prices. And also don't forget that if you compare it to the gas price, of course, in the gas market, when you are in a situation of scarcity, You don't have the choice. You are buying whatever the price. In the UE market is not the case. The compliance date is far away, so you are not in a hurry to buy. And this could also explain why prices are not following totally the surge in gas prices, just trying to increase gradually with an uptrend, which is still rather comfortable. The next one, Julien. On the next one, we'll switch now to the European power market with some fundamentals on Germany and France. Just recall that if prices are too high, it's not really because of a tightness in the power balances. They are rather comfortable. Of course, you still have some volatility due to renewable production. But when you think about nuclear production in France, for instance, you are still at rather comfortable level. So the sharp rise is clearly due to the increase in fuel cost and gas in particular, as you can see it on the graph on the right. And all European countries are impacted, of course, and depending on countries, you can have some minor variations, but the trend is clearly upward for all countries on the spot. And this is even more true on the curve. Just look at the graph on the bottom. On the bottom, year-ahead prices are faithfully, let us say, mirroring the trend in clean fuel cost, gas in particular, because even though in some countries you can have a rather weak level of thermal generation, gas or coal, these levels are still high enough to continue to allow gas and coal to set the marginal price. So this is true on the spot and even more true on the curve. Julien? So this leads us to the last slide when you try to draw a kind of outlook. Not so easy, because I will turn to Adrien. Adrien has the key. The gas market will be key to tell us what will happen on the power market, and you can see it when you look at the graph on the left. With clean gas cost, clean cost, and we compare them to baseload prices in France and Germany. Starting Jan 2020, you see that faithfully power prices on average, we are on monthly averages, they follow the trend in clean gas and clean coal cost. At that time, I will say that the situation maybe was much more easy to forecast, just because the spread between the two was minor, and that lower spread errors, in fact, part of the volatility. For next winter, you see clearly that gas, of course, is higher in terms of cost. Coal costs are lower, so you are adding a huge volatility between the two, depending on your outlook on the gas and coal market. Of course, if you are very comfortable on the gas market because tomorrow you have additional flows from Russia, you'll have a drop in prices, gas prices, and your green bars will drop probably toward the coal bars. But as long as it's not the case, it means that gas prices will continue to trade significantly above, fueling some volatility, because on a spot basis, if you need gas plants to run, you'll have to pay that price. Otherwise, if you don't need them to run, you just need coal prices to run and be on average marginal, you can drop to the level of coal costs. So huge volatility inside, just because of what will happen on fuel cost. And on top of that, for next winter, we have another hurdle, which is what will happen in terms of nuclear. Don't forget that Germany will close around 4 gigawatts of nuclear capacity. And to us, this explains why the market is on top of the fuel cost, adding a premium, particularly in France, because it is the market that is more sensitive to the weather, adding a premium on top of that. Is this premium justified? We don't know. Of course, this will depend on your power balance, your true power balance during the winter, depending on the level of renewable, depending on the weather, if you need more power or not. And this is also adding another component to the volatility you can have for the power price during that winter. So very difficult to have a real forecast for this market, because all will depend on the gas side on the one hand, and also what will actually happen with disclosure of nuclear capacity in Germany. And to finish, can talk about the graph which is on the right. So this is the curve, still very backwarded, strong backwardation due to the backwardation in the gas prices in particular, and a little bit on coal prices as well. So when you look at the distant maturities, 25, 26. Although they did not totally follow the rise in the frontier contract, of course they are upward, and we believe that at such levels you can think about some alternative renewable based supplies, because those supplies on renewable base are competitive for at such market price levels. So that's it for me, Julien. I don't know if you have questions.
Yes, thanks a lot, Evariste. Yeah, just to go back to your last comment regarding the backwardation of the German power curve. Do you think it's justified from a fundamental point of view, as you talked about the nuclear phase out? We know that there is also a coal phase out ongoing. So does it justify this kind of shape?
We'll start with the front calendar, because all is decided with this front calendar, and to see if the price level is justified for this front calendar, Cal 22. You can just look at the graph which is on the left. So the graph is starting with the winter period, and you see that the German price is trading around the gas cost. What the market is telling us is clearly that to balance, I will need gas plants. To me, when you see that, of course, I will say, yes, it's normal. It's normal. It's even more normal this year because you have less nuclear. So I will tell you that, yes, I believe that given the level of the gas market, the power price seems at a rather fair price. I don't know yet what will be the true balance for Germany. Nobody knows what will be the true balance for this winter. But taking some average assumptions, having a price set by a gas plant seems to be rather relevant. And then when you switch to the distant maturities, is the level of the Cal 23 justified? I don't know. I think that the backwardation is justified, but the level of the backwardation, yes, you can question it. But as is the case for Cal 22, nobody knows what will be the true balance for 23. So the market is trying, guessing to set a kind of spread between the two contracts, but without knowing exactly what will be the balance, the supply-demand balance for Cal 23.
Okay, so just one last question before we close this webinar session. So we talked a lot about demand destruction for natural gas markets. Do you think that we need also power demand destruction this winter to balance European markets?
Yes. For me, the two are linked, and just remember what we show about the Asian market. In Asia, clearly, I will say that the measure are focusing on power. To me, the two are linked. You need demand destruction both for gas and power, for sure.
Okay, thanks a lot, Évariste, for your presentation and for your answers. So it's time to close this webinar session. The next one will take place in January 2022. So once again, we apologize for all these technical issues we had this morning. And thanks a lot for your attention, and see you soon in our EnergyScan platform.